Let's bring in Shane Obata for his take on markets. Shane, thanks so much for joining us.
Thanks for having me.
Have you been selling any bank stocks or lightening up on your exposure to the financial sector?
Not too much. I think we're generally underweight banks as a firm, so that's been beneficial this week. But I think we're more looking for opportunities in the sector, maybe not specifically banks, but looking at different companies such as Blackstone, Brookfield, one of which I'm going to talk about later. So.
Okay.
Yeah.
You are interested in growth stocks, broadly speaking?
Well, the firm does equity income, specifically, for generally speaking, but within certain pockets of the firm, for example, we have some sustainable focus strategies. Those ones will have exposure to clean tech, for example. That's not often not going to give you a dividend. So.
That's interesting. So you're at Middlefield. Sorry, I should have known this. You're very much about an income mandate. That's what your investors come to you for?
Yes.
Oh, that's
broadly speaking, yeah.
Right. So that's been a bit tough with this rapid rise in interest rates in the sense of holding equities that provide a big income have been under pressure.
Yeah, it has been. And I think a broader theme here that we're focused on really is just rates volatility. It has been so high, right? And I think markets across the world, real estate, infrastructure, private debt, et cetera, from what we're hearing, it seems a little bit locked right now, right? Because you have big bid-ask spreads in the sense of people having a hard time coming to an agreement on pricing. And I think that's a reflection of the uncertainty around rates. So
in the fixed income market?
Well, in different markets, in real estate and, like I said, private credit as well. So basically what I'm getting to is I think that we know inflation is still a little bit uncomfortably high, but this week has made it maybe more difficult. We're going to see what happens with the Fed. But the point I'm trying to get at is I think when rates volatility comes down, that's when people can start to get a better idea of pricing of different assets. Mm-hmm. Just to say, okay, the hiking cycle is over. If it is soon, let's start repricing things. People will get a little more accustomed to things. And we're seeing some indications of that in U.S. real estate, for example, right? People were coming back into the market as rates come down, then they went back up. They're paring back. It's just the uncertainty, right? So I think as that becomes a little bit less volatile, that should really help the broader markets. It should help deal making, and I think that's an important theme.
Let's kick off with an email from Carol. Carol wants to know about NVIDIA. Do you still like this one?
Still love it. It's tremendously expensive, so I think it's easier if you already own it to hold it, but it's tougher to buy. So we've continued to hold it. It's done exceptionally well recently. I think we're caught up in another hype cycle, which is something that scares me a little bit, but it's a great company. When you're talking about some of the purest plays on AI, this is one of them for sure. So there's a good story out in Bloomberg the other day that was talking about when they made their initial partnership with OpenAI, they promised that they would build a supercomputer for OpenAI. And they didn't really have the components to do that. So what they did was they spent several $100 million on basically attaching a series of NVIDIA's GPUs together. So that's an example of basically right now, if you want to have those capabilities out of the box, so to speak, you're going to them. So
NVIDIA.
Yes. So it's a great company. Like I said, expensive. I'd prefer to buy it lower. We're going to continue to hold it and kind of hope for a better place to add, but it's a great company for sure.
That's interesting. I mean, we've heard they're big in video games, we know that.
Yes.
Self-driving cars with their optical processing and AI.
Yes. Yeah, AI is the new thing. Jensen Huang is a master salesman, so when he kind of took the AI theme head on and embraced it, I kind of got scared because it reminded me of crypto a little bit. But I would say this is very different. But yeah, to your point, gaming's still an important driver. I want to see how consumers take on the new 40 series, which has been cited as pretty expensive. Obviously, in an uncertain time for the economy, big ticket items with $1,000 GPU chips, it's not cheap, right? So But anyways, great company, diversified. Like you said, the automotive stuff is getting interesting, right? They have a new partnership with Mercedes-Benz as well, so it's a good business.
Jensen Huang, the CEO of the company.
Yes.
Yep. Okay, we have an interesting email from Catherine. Wants to know about LNG. Where would I invest in LNG for the long run?
Yeah, so one way that our energy team likes to play this would be through Tourmaline, so largest natural gas producer in Canada, one of the top 5 in North America.
TOU?
Yes, and so one interesting thing that I like about this is that they're selling, I think, over 20% of production outside of Canada, so into the States and into Asia. So that allows, even after transportation costs and other costs are taken off, for some arbitrage. So that's interesting.
Okay, so Tourmaline would be one of your favorite names there. Susan in Montreal, go ahead, please.
Hi, I'm calling about Enbridge, and I want to know, is it, like, I bought it a year ago, and this company does nothing. It just goes down and down and down. So should I hold it or should I dump it? Thank you very much.
Hold or dump.
Yeah, Enbridge has been a core holding for us for a long time. I think maybe the growth outlook is a little more muddied now by potential competition coming online and whatnot. So, but if you're owning this as a safe exposure to energy with a high dividend yield, I think it's something that you can continue to hold. I don't think you're going to get hurt too badly in this name over time. So.
Let me just check what the yield is on Enbridge right now, just over 7%.
Quite high.
The stock, though, slipping this year down around 5%. Is it because I'm assuming that Trans Mountain, when and if it comes on, will produce more competition for Enbridge?
Yes, I think that's right to say, and so that makes the economics a little more challenging. You've got more competition, so maybe you don't get as much capacity as you would have had before. So,
Jordan is calling from Calgary. Go ahead, Jordan, please.
Hi there. Good morning. Thanks for taking my call. My question is about Moet Hennessy, Louis Vuitton. Just wanted to get your thoughts on the luxury goods market. Thank you very much.
Thank you.
Yeah, we continue to like it. It's a market that operates completely differently than everything else in the sense that the demand price function is completely backwards.
Yeah.
Prices go up and there's still high demand. And part of the whole thing behind this is kind of at least perceived scarcity, right? It's scarcity, it's prestige and whatnot. So this is the best luxury company in the world, in my opinion. Their portfolio is spread across a lot of different things. Louis Vuitton fashion leather goods is the crown jewel, but they're also in wines and spirits. They're also recently acquired Tiffany. I can't remember the time frame right now, but after it was acquired, they've doubled sales already. It's a great business. It's typically going to trade more expensive to the market, but it's one of the best players. The luxury industry is really consolidated into these holding companies that own a swath of brands. So another one would be Kering, for example, that owns Gucci and YSL and other names. So they've all found themselves under these different conglomerates, if you want to call them that. And I think that model works, and it should continue to work. This is a great long-term holding.
Sorry, who owns Gucci?
Kering.
Oh, okay.
Yeah.
Oh, yeah, Kering. Yeah, that's interesting. It is weird economics. People want to pay more for these things.
Well, it's also catering to part of society that doesn't have to deal with the ups and downs of the economy perhaps as much as everyone else. So.
Okay, we're going to be back with Shane Obata, Portfolio Manager at Middlefield Capital, and he'll be taking our questions on global and North American large caps. Okay, we have an email from Max. Max is thinking about pharma stocks. AbbVie versus Pfizer. Which one would you recommend?
I think AbbVie, our healthcare team, likes AbbVie more than Pfizer. So we'll start with Pfizer, I guess. The main overhang here is really coming out of COVID and what happens now with the vaccine franchise and whatnot. So that's obviously up for debate. And so the company is going to need other engines. They've been doing some deal making recently, but I think it's more of a show and prove story. So our team likes AbbVie more as a long-term hold. So AbbVie is one of the leaders in immunology.
Okay.
And the main overhang for AbbVie is that Humira is coming off patent in 2023, but this is something that's already well known by the market.
What is Humira? Is it a cancer drug? I'm just trying to remember. Carry on. Sorry. Anyway, I can check it out. So
Yeah,
anyway, coming off patent. Yep.
Yeah.
Okay.
So Humira is coming off patent.
Yep.
And that's basically going to compress revenues and compress earnings. But this is already well known to the market, and our team thinks that the pipeline will help for. It's for Crohn's and
Right.
Yes.
And as you say, it's to do with the immune system. It's
Right.
an antibody remedy. Yeah.
I believe so. Yeah.
Yeah.
So, anyways, the pipeline is going to come through and help to offset some of that pressure. And then we also have they also have an aesthetics business, which includes Botox, which is obviously there's a cyclical element to that, but I do think that's something that should do well over time.
Apparently, the human immune system is so complex that in some ways the microbes manage our immune system as much as we manage the microbes. It's just so
Right.
Yeah.
That's why you want to get out and play in the dirt so you can build your immune system.
That's right. Get the kids out there.
Yeah.
And even having a dog in the house can be good because dogs bring in filth. And,
Yeah, they sure do.
but it can be good for the kids. Yeah.
In a weird way, yeah. It's a symbiotic relationship.
Yeah, it's incredible what we've evolved over millions of years. We have an email from Wendy. Wendy is saying, I'd like to add a big industrial. What do you think, GM, Toyota, or Tesla?
Depends on your risk tolerance. I think for us, we've been looking at GM recently, but haven't taken any action. Toyota is, I would probably say, a safer bet for the next year or so. It's a giant company. Its profits are improving. We're still yet to see exactly what's going to happen with their EV strategy.
Yeah.
That's not necessarily going to be a game changer in the next year or so. Let's just put it that way.
Yeah, because Toyota's been seen as something of a laggard, hasn't it, in electric cars?
For sure, for sure. Their strategy, initially, they were deciding to stick with hybrids, which was a good business for them, right?
Uh-huh.
And now they're really trying to build out their strategy. So there is a theory that they've waited to see battery technology get better and better because it's continuously turning over. And then when it gets to where it needs to be, they will fully get into the market. So there may be some truth to that. But GM had a really good quarter recently. I think you're going to have pressures on the financing side of the business. Effectively, like many finance businesses, a spread business. So if consumers can't afford to pay up for leases, then that will compress the financial services side of the business, their spreads. So that's one thing. And then the other thing is we think that their targets are pretty optimistic. So I just think it might be difficult in the following year. And then Tesla, I would say that's our favorite EV play in the automaking space.
Okay.
I'll say I think they've already won the EV race in a couple different ways. So the first one is really vertical integration, right? When you're talking about Tesla versus GM could be trying to retool a factory that was originally made for ICE vehicles. And then you have these utilization problems, for example. Let's say you had a factory that was putting out 100,000, maybe that's not the best number, but just for the sake of simplicity, of 100,000 ICE vehicles, if you're going to produce a tenth of that on the EV side, then your utilization isn't there, your economics aren't there. So that's where the part of the advantage comes from for Tesla, is that they are built to make EVs and EVs only.
From the ground up, yeah.
Right.
Of course, by ICE, you mean internal combustion engine.
Yes.
Yeah, no. There's one interesting angle here. The Daily Telegraph in Britain reports that BMW is getting more interested in hydrogen cars.
Yeah.
Toyota has been a leader there.
Yeah.
Because, of course, the hydrogen cars, you can refuel them in a snap and they've got great range. So maybe, I mean, it's been a laggard to lithium, but...
Yeah. I think from my perspective, just taking it to the fuel level, the economics aren't there yet, generally speaking, for hydrogen. When we think about the renewable energy space and what's already there and it's going to take a long time. So I think that might challenge it. But as with energy in general, I think we need a lot of different sources, right? So it's good to try a lot of different things and see what works.
Walter is calling from Hamilton, Ontario. Go ahead, Walter.
Good afternoon, gentlemen.
Hi there.
Still down about a third from its high. S&P Global International and fintechs in general, are they going to catch any love in the market soon? Thank you.
Thank you.
S&P is a good business. They do a lot of different things. They do market intelligence. They do like commodities data and whatnot. Indexes, obviously, are part of the business. But I think the upside angle, we don't have a position right now, but it's a stock that we follow. The upside is going to come from the resumption of coming back to my whole starting ramble about rates volatility.
Right.
Once issuance picks up again, because that's been in the doldrums, companies like S&P and Moody's are going to be the beneficiaries. So I think this will work as the capital markets kind of recover and reopen and issuance gets back to more normal levels.
Shane was on our show May 6th of last year. Now, they're US companies, and over that period, the NASDAQ 100's down about 5%, the S&P 500 down about 6.5%. So let's see how these picks did. Advanced Micro, AMD, this one down about 9%.
Still like it. So whereas it's difficult to wrap the head around valuation for something like NVIDIA, AMD, I think is a little more reasonably priced. I am kind of wondering if in the short run, the Intel AMD trade is a little bit played out in the sense of Intel being a giant laggard. But we had some confidence holding this despite semiconductors being very volatile, right? Very high beta. But where that came from was really AMD continuing to take share from Intel, especially in server processors. So whereas I think there's opportunity, like coming back to AI, I think there's opportunities around the edges. Like all we're hearing about is the GPU side, right? That's all you see.
Which is the chips?
The graphics chips.
Oh, the
that
graphics
NVIDIA,
chips, I'm sorry, yep.
Right,
Yep.
Whereas the CPU chips are more like the brains, the computers that run your computer system. So I think it's fair to say as you're building out supercomputers and facilities that can enable AI, you're going to need a mix of both, right? So I think AMD can benefit from that as well, perhaps not in GPUs, but in CPUs. And then, yeah, they've done a great job executing over the last 5+ years. So I think we can expect continued share gains from Intel over time.
Let's see how Blackstone did. A huge player in private equity, but also in commercial real estate. This one down over the period.
Yeah. Still like Blackstone. You're right, there's a big exposure to real estate here, but there's two sides of the coin. The first one is that they're in the midst of it with the assets that they already have, but these are fundraising machines, right? Blackstone has nearly $90 billion in dry capital and dry powder right now. And so on one hand, you worry about existing assets, but at the same time, you're able to deploy into a market that's obviously depressed, right? And I think real estate investors would generally agree that because of rates and the sensitivity of real estate as an asset class, a lot of stuff has probably been pushed down too low. So I think you have to take the opportunistic angle here and think that they'll come out with a lot of good assets.
And finally, let's check out Amazon. Now, they pushed through a 20-for-1 stock split on June 6th. So we got to adjust for that. We're calculating the stock down about 19%.
Right. So another disappointment, but only over the time frame. I think Amazon is another good long-term holding. They're the leader in e-commerce, and I think really that comes down to their logistics capabilities, right? I'm sure you're finding a lot of stuff showing up at your doorstep a day after now. that could get to a matter of hours at some point, right, for certain products. So they've got that exposure, but I think it's also interesting. The whole story here going forward, especially given the economic climate, is going to be about improving margins and profitability, right? So Amazon went through a spending cycle to build out their capabilities during COVID and whatnot. So I think we're kind of normalizing there. Cost growth should come under control in the e-commerce business. And then you also have upside from AWS and advertising becoming larger and larger parts of the business. And those are vastly more profitable than the group. So all of those things should come together to raise group profitability over time.
Let's have a look at the markets here, because this Credit Suisse near meltdown is playing out in stocks. And we've also got a weak energy market today. Oil has been trading below $70. So the TSX now down around 1% this year and down almost 3% on the day. So we now have, Toronto is down around 1% in 2023. The S&P, and you can see the sell-offs getting worse, S&P 500 is now up only 0.2% so far this year. There is the Dow. The Dow is in fact down the year to date 5%. Bloomberg reports that there's a massive rush to buy credit default swaps in Credit Suisse, and they're a form of insurance against a company going bust, or at least hedges you against losses. And apparently banks are scrambling to buy these credit default swaps. They go up in value as a company seems to be in trouble. Oh, okay, there's the S&P. Thanks, control room. You can see the sell-off. Well, we're near the lows of the day. Let's have a look. Let's have a look at the old volatility index in the States. You'd expect it to go up on a day like this, and sure enough, it's jumping. We'll be back with Shane Obata. He's taking your questions on global and North American large caps. We have an email from Michael. Could you tell me what your favorite pick is in the waste management space and why?
Yeah, it's an interesting business. I think one thing that we look for is market structure, of course, right? So when you have oligopoly, duopoly structures, you tend to get better pricing. You don't really have an option for where to go. So Republic Services is a name that we like. That's the second largest waste management company in North America. One interesting tidbit is there's a holding company called Cascade Investments, which is controlled by Bill Gates. They own 35% of this name. He has these different areas that he really likes, like waste management and ag machinery, stuff like that.
He's gotten into rail in the past?
Yeah, I think so. So, and again, you can see the similarities in some of the market structures there, right? So bottom line with them is stock is a little bit expensive, probably in the low 20s on a forward PE, so significantly more expensive than the market, but you do get a degree of resiliency built into this. Their pricing is around 50% linked to inflation in some way or another, and the remainder comes from open market. And actually the open market stuff is where they can get more of a pickup. So I like how it's set up in that sense. So this is one that we think can continue to work.
We have a caller, Paolo, in Ottawa. Go ahead, Paolo.
Hi, how's it going, gentlemen? Can you hear me?
Yeah, we got you. Thanks.
Excellent, yes. Good afternoon, I'm just wondering about TSM. I bought it around 88 as I saw it straddling the trend line here, starting from November. I like the company, I like the fundamentals. Just wondering, is there anything to be worried about, or just to hang on, keep adding? Thanks so much, guys, and shout out to my family. Thanks so much.
Taiwan Semiconductor.
It's a good company. I don't own this currently, but I have in the past. The main risk here is geopolitical, right? It's how do tensions between China and Taiwan escalate? I do think, though, that some of the recent moves, building some facilities in the States and whatnot, helps to mitigate the risk of something happening there, but that is the main risk. But bottom line is best foundry in the world. All of the chip makers, AMD, NVIDIA, they all use TSM. And now part of the reason, coming back to Intel a little bit, that we were worried about their strategy was, so now you're going to expand your foundry business, but look who you're competing against. You're competing against TSM. So you're going to spend a lot of money and potentially not do what you need to do there, which is secure contracts from people. Why would they go with Intel? Unless TSM is at full capacity. But anyways, great company. The main risk, like I said, geopolitical. But I think absent something crazy happening there, you can hold this for a long time.
Okay, TSM getting the nod there. An email from Fred. I'm holding First Republic Bank. Would you still hold? Would you still hold? Would you sell? Would you have a suggestion for a replacement in the sector that's safer? So we've seen major selling of First Republic Bank over the past week.
The concern coming out of the weekend was how are depositors going to react to this just across the board, right? And so we're seeing that in the share prices here. I think if you want to get more safety, you go to the bigger cap banks, either in the States or in Canada. Look at something like JP Morgan or Bank of America in the States. In Canada, our banks are coming back to the oligopoly structure, another attractive market in that sense. So I think those provide a lot more safety. So that's probably where we would be looking.
Yeah, both Fitch and S&P have cut them to junk. Belatedly, of course, they always tend to do this after the event occurs. According to Bloomberg, they're concerned about possible deposit outflows that could hurt the liquidity profile.
Right.
They're ramping up wholesale borrowing. I guess they have to pay more for that financing than deposits. Yeah, I love the way the credit rating agencies always gallop in after the event. Anyway, aren't they supposed to predict what's going to happen? Anyway, Bill in Barrie, Ontario, go ahead, please.
Thank you for taking my call. Could I have your guest's opinion on ASML Holdings? Thank you.
That's another chip company, is it? Okay.
Yeah. Keep them coming.
Yeah.
No, this is a great company. It's in machinery, so they have an effective monopoly in what's called EUV lithography machine, so extreme ultraviolet lithography. To simplify this as much as possible, as we try to pack more and more onto these chips, they get smaller, and we're trying to put more and more onto them. You need the most advanced technology. So at the lower nodes, which is where the kind of bleeding edge of this tech is now, you need these machines. So it's very defensive. That was one reason why we've continued to hold it, and through the past year plus, just with confidence because of their market position. So it's hard to imagine them getting disrupted anytime soon, though. I wouldn't be surprised to see competition at some point. But for now, rock solid. Definitely because of their position, one of the safer picks in semis.
Lawrence in London, Ontario, go ahead, please.
Good afternoon. I would like your opinion, please, on Coca-Cola or Pepsi-Cola. Thank you.
A classic question, Coke versus Pepsi.
I'm not going to speak about the drinks, but just the stocks. So I think they're both good. We like Pepsi more. Pepsi's has become more of a snack company and less of a beverages company. So we like that side of the business. The concern, and let me start by saying I think this is a good staple that you can own for a long time, but they're coming off of crazy price increases last year. So it's yet to be determined how they can kind of comp that this year. And so we'll need volume to pick up to keep the revenue line growing. But it's a good company. It's done well over the past 5 years, as you can see there. So it's one that we continue to like. But yeah, like I said, some of these staples companies were pushing through such tremendous year-over-year price increases, that has to normalize at some point.
What do you mean? Is it clear that they've succeeded, or has it hurt their sales?
I think in general, you probably see a little bit of elasticity, just meaning less volume, but nothing to derail the company from what management has told us. It's all kind of within what was expected.
Okay. Lawrence, thanks for that question. Kevin in Kingston, Ontario. Go ahead, Kevin.
We're leaving to go to the store.
I'm not hearing you, Kevin, but I think Mastercard is the question. Thank you.
Yeah, Mastercard. It's good. We've tend to prefer Visa, but they're very similar, obviously. So Mastercard gives you a little more international exposure, so that's kind of the toggle, maybe a little bit more growth. But you want to talk about a defensive business model, Mastercard and Visa are two of the biggest ones. And it's interesting to note that they're going to come and save the financial sector when they get transferred. Their GIC sector changes. I think that's coming up this week.
Oh, they get in the S&P 500?
Yes.
Yeah.
They're moving into financials.
I see.
Into the financial sector.
So they will make the financial sector performance look better then, I suppose. Yeah.
I think so.
Yeah, that's interesting. We have Robin calling from Tillsonburg, Ontario. Robin, thanks for joining us. Can you remind me, do they still grow tobacco around your area at all?
Oh, yeah, they sure do.
Okay. Thank you. What's your question, please?
I just wanted to say great show, Andrew. I love listening to it. And my question for Shane is about Apple, and if this is a good entry point, or should I wait longer? Maybe there's more rough times. I don't know.
Thank you very much. Apple.
It's great. It's great. It's one of those companies that we would like to add to lower, but it holds in so well, right? It's one of the best all-weather stocks around. It performs well in periods of volatility. There's an element of safety here, right? So in terms of trying to pick a spot in the short term, that's obviously very difficult, but I do think the main driver of Apple going forward is going to be continuing to get that installed base to, if you look at every device as the potential for more services growth, whether it's Apple Music, cloud, et cetera, that's really where the story is going to come from going forward. That continued shift into services and getting people to spend on subscription type models. So iPhone's obviously still good, but I think that's where we're going in the future.
Oh, okay. Yeah, certainly I walked by the Apple store in the Eaton Centre in Toronto yesterday, and it was packed. It was full.
I feel like that's always full whenever you go by. It's like a McDonald's drive-through, same thing.
Or Tim Hortons. There's always a lineup at Tim Hortons. Okay.
That means something.
Yeah, it does.
It really does.
Yeah. You always have to wait at Tim Hortons, in my experience. Anyway, I need my steep tea. Topic number one, Sony.
Sony, yes, great company. This is a pretty diversified business, but I'll focus really on the entertainment assets today. So in gaming, we know Sony makes the PlayStation 5. That had some issues in terms of production because of supply chain issues, as we saw with many, many other companies. So the deliveries there are picking up right now. We've seen some estimates that are around getting close to 2 PlayStations sold for every Xbox. So they're doing a great job there. The other parts of the business that we like, the music side, Sony is one of the 3 main music companies around, the other 2 being Universal and Warner. That business has really seen a resurgence with streaming. And those economics, a lot of them go to these 3 companies. And the other thing on the pictures side, so that's TV and movies, I think one thing to think about that's really interesting is if you've been, I don't know if you're watching Last of Us.
Oh, I am.
Okay. Did you know it was a video game?
Yeah, and apparently the scenes in the video game, I haven't played the game, but mirror the show pretty closely.
I have also not yet played it, but it's a great show. This was a story that was pitched a long time ago, the cross kind of synergies between IP, from gaming to shows.
And it hasn't, I mean, we've seen some movies,
Right.
but yeah, it hasn't seemed to have really taken off.
But
Yeah.
to this extent, right?
No.
It's been a huge
They're
hit.
blending the two, yeah.
Right. So I think there's a lot of potential in this going forward. It's a real thing, clearly, and Sony has a lot of 10 out of 10 games, right? This was widely regarded as a kind of a masterpiece in gaming. They also have the God of War franchise, so they're good, really good intellectual property here. So it's a good company.
Yeah, that's home box office in Canada. Yeah. I just watched the famous third episode, the long love affair between the two guys, and yeah.
Spoiler. No, I'm kidding.
I know, I'm not going to say what happens, but yeah, I was crying, I got to admit, towards the end. Enphase Energy, remind us what they're all about.
Yes, this is solar inverter company. So basically, when you have panels, you're going to get direct current. You need to convert that into alternating current for your house. And so they make the microinverters that allow you to do that. They fit with the panels, right? And their technology is kind of taking over the old technology, string inverters, which, just to make it simple, more efficient, more flexible, whereas string inverters basically would help you to control an entire kind of array there. With microinverters, using Enphase's technology, you can really get specific to each individual module. And so that creates for greater efficiency, better ability to kind of harness the sun's power and whatnot. So they're also turning from like a component type of situation to systems, which is always a good thing in technology. With that, I mean, we started with the inverters, and now we're moving into storage and EV batteries and whatnot. So
they might become turnkey, kind of, or provide a suite of things anyway.
Right.
Yeah.
So I think one interesting way to think about this is like in the semiconductor industry, they would talk about it as like number of sockets that a competitor can compete with you in, right?
Right.
You have 3 different things. Those are all potential points of competition. But if you combine those 3 things into a system that works, you're only giving your competitors one place to attack. So I think that's an interesting way to think about it.
Okay, and then your final idea here is Brookfield Asset Management, which is the spun-off asset management unit.
Right. So following the spin, we now basically have the most pure play exposure to fee-related earnings. Fee-related earnings, mostly on third-party capital, are the most sought-after, highly valued part of the alternative asset managers. I'll compare that to like carry, for example, right, which is going to depend on transacting and is more lumpy. So
compared to what? Sorry,
carry, like performance fees.
Oh, I see. Yeah, carry fees. Yeah,
yes,
yeah.
right.
Okay.
And also transactions and whatnot, having to unlock value that way. Those things are lumpier, right? So with this, you get almost pure exposure to the management fees. There's no carried over. I hate to use that twice, but from BN, the carry that accrues to BAM will only take effect in a few years. So the point is, right now it's pure exposure to management fees. So I'm sure you're thinking about the exposure to real estate.
Right.
Yes,
yeah.
That's a thing. 25% around of fee-related earnings. Significant, but not I think the really interesting thing here is that they're overexposed relative to, like a Blackstone, for example, to infrastructure and credit. 2 areas that should do pretty well in an inflationary environment. We know infrastructure, long life assets, inflation escalators, that sort of idea. I think that will continue to hold in. And then the credit side, there's obviously opportunities there given the carnage we've seen in the markets and their ownership in Oaktree.
So they may be able to pick up things.
That's kind of the same thing I was saying about Blackstone applies to BAM here, right? They just finished fundraising for one of their flagship real estate fund. So while some of their properties might be having a little bit of issues, they just raised $15 billion that they can now deploy into a depressed market. So same idea. I think this is a good, same with Blackstone, good environment for people who have capital available.
Okay, Shane, thank you very much indeed.
No problem.
Let's have a look.